Hello everyone and welcome back to Bullion 79. I'm Goldie. In today's video we're going to continue with the bond topic we touched upon last time. So we're going to dive deeper into the topic we discussed last time, US bonds and the illusion as an investment for individuals. But before we start, please like and share this video. And don't forget to press the bell button so you don't miss any of our newest videos. So let's continue from where we left last time. We discussed how the government encourages you to buy bonds. And we can't talk about individual investors without addressing the yield curve. Well, the yield curve is seen as an indicator that has foreseen almost every recession in the past. However, it's just an indicator. What you need to understand is that bond prices and yields move in opposite directions. This might seem confusing if you're new to bond investing. When bond yields go up, prices go down and vice versa. An upward change in the 10-year Treasury bond yield from 2.2% to 2.6% indicates a negative condition for the bond market, as bond interest rates move up when the market trends down. This happens largely because the bond market is driven by supply and demand for investment money. When there is more demand for bonds, the Treasury doesn't have to raise yields to attract more investors. But what if we're in a situation where debt keeps piling up? Investors aren't buying enough bonds to fund the government's overspending, and interest rates can't go further up. That's the situation we're in right now. There simply aren't enough buyers to fund the government via bonds. So just like I asked in the last video, do you think it's a coincidence that whenever there's a stock and crypto rally, within the same week as these bond auctions, the media talks about recessions, market crashes, etc., the only option left is monetizing the debt, which is already happening. So to understand this topic a bit better, let's go to the bank failures last year. So in 2023, failed banks were forced to buy government bonds with printed bailout money provided by the Fed. But since it's a loan, it's not calculated in the money supply. However, it still increases the money supply and demand in the economy, which in turn increases inflation. This is essentially printing money and monetizing the debt with extra steps. So let's briefly touch on the bank bailouts by the Fed in 2023 and how this debt monetization started. So it began with the bank run on the Silicon Valley Bank, which held most of its assets in mortgage-backed securities and government bonds. As interest rates rose, the value of these underlying bonds these banks were holding decreased. That is prompting investors to pull their money out. To bail these banks out and essentially continue funding the government, the Fed bailed out these banks by forcing them to hold a certain amount of new government bonds. So not the Fed forcing them, but the government is forcing them to do so. The funds for these bonds were given to the banks through the Fed with a loan. So the outcome remains the same. More money is created, that increases demand in the economy, and that causes more inflation. So when that happened, in that situation, the Fed only had two solutions, both of which result in some kind of pivot, so to speak. So the first option is for the Fed to buy all the bonds and mortgage-backed securities off the bank's balance sheet to stabilize the banking system. The second option is to lower interest rates to make the underlying assets these banks were holding on their balance sheet worth something again. So there's no third option. The Fed's actions, which included bailing out a few banks, hoping the problem would just resolve by itself, have not been sufficient. Back then, when interest rates were near 0%, people avoided variable rate loans and instead got fixed rate loans. That secures actually a great deal on real estate. However, the banks are now left holding the bag, so to speak, because to yield some return, since rates were near zero, they had to load up on long duration bonds. Moreover, the government forced banks to invest in government bonds. Banks like Silicon Valley Bank were mismanaged, but the underlying issue is that there is no way to fight inflation without impacting the banking system. Interest on the national debt doubled since 2021 from $300 billion per year to $600 billion per year. That's 90 billion, 9 zeros. So to keep the government solvent, the Fed will likely cut interest rates, which is why the inverted yield curve doesn't necessarily signal an imminent recession. Interest rates will probably come down because the government can't afford to pay over 5% on the national debt. This situation is very inflationary. By 2026, interest on the debt could reach and exceed even $1 trillion. How will the government manage to pay approximately 20% of all their tax revenue just on servicing the debt? And they have to do so while funding more wars, more welfare, which are all inherently inflationary. The likely answer is more money printing. Now, understanding that the US dollar is the world reserve currency is crucial, as not only individuals but also countries buy US bonds. There was a crossover event between the G7 countries and the BRICS countries in 2020-2021, where BRICS overtook the G7 economically. Back in the Bretton Woods system, the US dollar was pegged to gold. And that was fine until France demanded their gold back. And under Nixon, the US removed the gold standard, starting the debt-based system and the petrodollar. This allowed the US to essentially export inflation globally without directly absorbing the consequences. However, this is changing. Right now, BRICS Pay, an alternative system, is being tested by Iran and Russia. It's not a simple task and won't happen overnight, but they will test it and work out the glitches before implementing it on a larger scale. So back in the Bretton Woods system, the world accepted the switch to the debt-based system because there was simply no alternative. But now, there is. Soon, countries will realize that they don't need to hold US dollar reserves or even need the US dollar to trade at all. Then these reserves, which are currently frozen on the balance sheets of these countries, will be rebalancing, selling their dollars and flooding the economy with US dollars. And we're talking about trillions upon trillions of dollars. And that will cause horrible, horrible inflation. So how long will this ship continue to sail? Maybe until after the elections? It's hard to say, but it's happening right now. And you need to take this into account when investing long-term into the future. So that's it for today's video. Please like and share this video and let me know what you think in the comments below. Good luck and cheers as we navigate these crazy times together.